safety, in the modern financial world, is an elaborate architectural illusion. For decades, the global economy has rested upon a single, unshakable foundation: the belief that sovereign debt, specifically the debt of Western nations, is the risk-free benchmark against which all other value is measured. We have been taught that while corporations can fail and individuals can go bankrupt, a sovereign state with the power to tax and print its own currency is immortal. However, as we move through the first quarter of 2026, that fundamental assumption is undergoing a violent and irreversible correction. We are witnessing the beginning of what historians will eventually call the sovereign debt trap, a scenario where the very instruments designed to provide stability have become the primary drivers of systemic instability. This is not merely a market correction. It is a structural disintegration of the social contract between the state and the holder of its currency. To understand the gravity of our current situation, we must look beyond the daily fluctuations of the stock market and examine the structural decay of the global bond markets. In early 2026, the cost of servicing national debt in the United States and the Eurozone has surpassed military spending and Social Security budgets combined. This is not a temporary spike. It is the mathematical result of a decade of zero interest rate policies followed by the aggressive, necessary tightening of the last 3 years. The cheap money era created a mountain of obligations that can only be sustained if interest rates remain near zero. But with inflation embedded into the supply chain and the dronification of global conflict driving up defense costs, the era of low rates is dead. We are now trapped in a feedback loop where higher rates increase the deficit, which requires more borrowing, which in turn pushes rates even higher. This is the definition of a fiscal death spiral, where the government is forced to borrow money just to pay the interest on the money it previously borrowed. The illusion of the risk-free asset is evaporating before our eyes. When an investor buys a government bond, they are not buying a share of productivity or a piece of innovation. They are buying a promise of future tax revenue. But in a world of slowing demographics, aging populations, and fragmented trade, the ability of states to extract that revenue is reaching its physical and political limit. We are seeing a massive rebalancing of expectations, similar to the one we discussed regarding digital assets, but on a much more catastrophic scale. If Bitcoin was a thermometer for liquidity, the sovereign bond market is the furnace itself, and the furnace is beginning to melt. The implications of this meltdown are profound for every level of the global economy, from the multi-billion-dollar pension fund to the individual savings account. The crisis of 2026 is uniquely dangerous because it is not localized in the periphery. In previous decades, a debt crisis in an emerging market could be contained by the IMF or a coalition of Western central banks. Today, the crisis is at the core. The United States Treasury, once the safest haven in human history, is facing a crisis of confidence that would have been unthinkable just 5 years ago. Foreign central banks, particularly those in the expanding BRICS Plus bloc, have accelerated their transition away from dollar-denominated reserves. This is not just a political statement. It is a defensive maneuver against the perceived insolvency of the Western financial architecture. They are opting instead for the tangible wealth we have consistently advocated for on this channel: physical gold, strategic minerals, and bilateral trade agreements that bypass the traditional interbank settlement systems. The weaponization of the dollar has forced the rest of the world to build an exit ramp, and that exit ramp is now the primary route for global capital flows. We must define the mechanics of the death spiral that is currently unfolding with technical precision. When interest payments on national debt reach a certain percentage of GDP, a threshold we have now crossed in 2026, the government loses its fiscal space. Every dollar printed to pay interest is a dollar that devalues the existing currency. This is the definition of a monetary trap. In this environment, central banks are faced with an impossible choice. They can either raise rates to fight inflation and trigger an immediate sovereign default, or they can print money to monetize the debt and trigger hyperinflation. There is no third option. This is the defensive realism that we must adopt as investors. The goal is no longer to seek explosive returns in speculative bubbles, but to achieve operational resilience in a world where the state itself is the primary source of risk. The state, which was once the guarantor of the rules, has become the most desperate player on the board. Consider the implications for your personal wealth through the lens of history. For generations, the standard 60-40 portfolio, 60% stocks and 40% bonds, was the golden rule for retirement and capital preservation. In the current debt trap reality of 2026, the 40% that was supposed to provide safety is now the most vulnerable part of the equation. If the underlying sovereign issuer is facing a liquidity crisis, the bond is not a hedge, it is a liability. This is why we are seeing the flight to quality move toward assets that do not represent someone else's debt. Productive land, energy infrastructure, and precious metals are the only assets that possess autonomy of value in a scenario where the interbank system experiences prolonged friction. We are moving from an era of return on capital to an era of return of capital, like. The fragmentation of the global order has accelerated this process of decay. The trade tensions and the breakdown of traditional supply chains have forced nations to prioritize strategic autonomy over economic efficiency. This transition is incredibly expensive. Building redundant factories, securing independent energy sources, and expanding military capabilities requires massive amounts of capital. Governments are attempting to fund this transition by issuing even more debt into a market that is already saturated and skeptical. The result is a crowding out effect, where the state consumes all available credit, leaving the private sector to wither. This is the great reset of expectations. The realization that the state can no longer be the guarantor of prosperity. It is now a competitor for survival. In 2026, the private sector is being suffocated by the government's desperate need to stay solvent. As we look at the specific regions of conflict, the European fragmentation is particularly alarming. The spread between German bunds and the debt of southern European nations has widened to levels not seen since the height of the 2011 crisis. However, unlike 2011, the European Central Bank no longer has the luxury of unlimited bond buying, without triggering a total collapse of the euro-ed-s purchasing power. The North-South divide is no longer just an economic debate. It is a survival struggle. Wealthy citizens in the core European economies are quietly moving capital into hard assets outside of the traditional banking system, anticipating a wealth tax or a digital devaluation as governments scramble to plug their fiscal holes. The social fabric of the Eurozone is being stretched to its breaking point by the weight of unpayable obligations. This brings us to the transition toward a permanent war economy. In this 2026 landscape, the concept of defense spending has been fundamentally redefined. It is no longer just about maintaining standing armies. It is about the dronification of the entire industrial base. The cost of maintaining technological parity in a world of asymmetric warfare is astronomical. Every missile, every surveillance satellite, and every autonomous naval unit is an expense that must be funded by more debt. We are seeing a militarization of the budget, where essential services are being gutted to fund the security of supply chains. This is the hidden cost of the end of globalization. The peace dividend of the 1990s has been fully spent, and the bill has finally arrived. The role of the central bank has shifted from being a lender of last resort to being the purchaser of last resort for the state. This is the technical reality of fiscal dominance. When the central bank is forced to keep interest rates artificially low to prevent the government from going bankrupt, they lose their ability to control inflation. In 2026, we are living with the consequences of this loss of control. Inflation is no longer a transitory phenomenon. It is a structural feature of the economy. It is the invisible tax that the state uses to erode the real value of its debt. For the saver, this is a slow-motion confiscation of wealth. Every year your money sits in a traditional bank account. Its ability to purchase a tangible wealth is diminished by the state's need to survive its own insolvency. We must also analyze the psychological state of the market. There is a growing sense of institutional nihilism, where market participants realize the system is broken but continue to play the game because they see no immediate alternative. This creates extreme volatility. When the realization finally hits that the risk-free benchmark is actually a risk-heavy liability, the exit will be narrow and violent. The transition into a permanent war economy is the decisive factor that seals the sovereign debt trap in 2026. Historically, military expenditure has been the greatest driver of sovereign debt, but in the current cycle, the dronification of conflict and the rise of asymmetric warfare have fundamentally altered the cost-benefit equation for nation-states. It is no longer a matter of simply maintaining standing armies. It is about sustaining an entire industrial and technological infrastructure of surveillance and defense. This requires a constant, massive injection of capital that the state simply does not possess through traditional revenue streams. This militarization of the economy is not an optional policy choice. It is a desperate response to the fragmentation of the global trade blocs. When economic diplomacy fails, the physical security of supply chains and maritime choke points becomes the absolute priority. National budgets have been transformed into instruments of strategic survival, where social welfare and infrastructure are being systematically sacrificed on the altar of operational resilience. This environment of technical insolvency is what justifies the aggressive global push toward central bank digital currencies, or CBDCs. We must not fall into the trap of viewing CBDCs as a mere technological evolution of money. They are, in reality, a mechanism for financial repression designed to manage the bankruptcy of the state. In a system of physical cash or traditional bank deposits, capital maintains a degree of mobility that allows citizens to protect themselves from inflation or sovereign risk by moving their wealth into tangible assets. CBDCs are engineered to eliminate this exit. By digitizing the central bank's liability and making it fully programmable, the state gains the direct power to impose deep negative interest rates, freeze funds selectively, and mandate consumption in specific sectors of the economy. In essence, CBDCs are the system's answer to the total loss of confidence in sovereign bonds. If the market will no longer buy debt voluntarily, the state will utilize the monetary system itself to force liquidity into its own coffers. The architecture of these digital currencies allows for what is technically termed financial enclosure. In an environment of unsustainable debt, governments inevitably turn to wealth confiscation, whether through extraordinary taxes or programmed devaluation. With CBDCs, this process becomes invisible, automated, and frictionless. It is the ultimate tool for debt monetization without the resistance of traditional bond markets. For the institutional investor, this represents the definitive end of monetary neutrality. Money ceases to be an autonomous store of value and becomes a coupon of access controlled by the state. This is why the most sophisticated capital in 2026 is abandoning centralized digital assets and seeking refuge in what we call resilience assets, physical metals, productive land, and exchange systems that operate outside the radar of programmable state tokens. The convergence between national security and monetary policy is now absolute. In the halls of power across Washington, Brussels, and Beijing, the control of monetary flow is viewed as an extension of national defense. The SWIFT system, which for decades served as the pillar of Western financial hegemony, is being cannibalized by state-controlled distributed ledger alternatives. This digital apartheid is dividing the world into two distinct spheres: one that attempts to preserve the dollar order through extreme digital surveillance, and another that looks toward the tangibility of commodities as a new basis for international trade. The result is a massive increase in economic friction. The efficiency that once fueled globalization has been replaced by redundancy and security, driving production costs to levels that make high inflation a permanent, structural phenomenon rather than a transitory spike. We must critically analyze the role of technology in this new order. While in the previous cycle, artificial intelligence was perceived as an engine of growth, in 2026, its primary economic application is the optimization of value extraction in closed systems. Algorithms are no longer just managing investment portfolios, they are managing scarcity. A state's ability to monitor every single transaction in real time through a CBDC allows it to adjust the money supply surgically, preventing a total systemic collapse while keeping the population in a state of perpetual economic stagnation. This is the stability trap. A system where there are no catastrophic bankruptcies because the state has total control over liquidity, but where there is also no real growth because capital is trapped financing a debt that can never be repaid. For any capital preservation strategy, this environment requires a fundamental redefinition of risk. Risk is no longer the volatility of price. Risk is now the confiscability and the lack of access. A treasury bond may maintain its nominal price, but if that capital is locked in a state-controlled digital wallet with withdrawal restrictions or diminished purchasing power through targeted inflation, its real value is zero. True financial intelligence in 2026 consists of identifying the breaking points of this system and positioning oneself in assets that the state cannot digitize, program, or delete. We are in a battle for individual wealth sovereignty, where the opponent is not the market, but the issuer of the currency itself. The militarization of the dollar and the euro has turned every saver into a geopolitical actor, whether they realize it or not. The culmination of this sovereign debt trap forces a shift into the era of tangibility. This is a period where value is no longer a ledger abstraction backed by state promises, but a physical reality that can be verified, possessed, and defended outside of digital channels. The collapse of confidence in sovereign paper is not the end of capital, but its migration toward a new architecture based on real scarcity and operational utility. The strategic exit is not about finding the next speculative asset. It is about building a portfolio of resilience that can survive the transition from the old paper order to the new commodity order. The first pillar of this strategic exit is the return to physical gold and silver, not as an investment, but as an independent final settlement system. In an environment where CBDCs can program the expiration of money and the SWIFT system has fragmented, precious metal regains its historical function as the only asset that is not someone else's liability. Unlike cryptocurrencies, which depend on a stable power grid and a communication infrastructure that the state can intervene in, gold possesses an autonomy of value that has outlasted every systemic collapse in history. In 2026, the central banks of emerging powers are accumulating physical reserves at a record pace. The gold standard has returned not by choice, but by necessity. For the individual, direct possession is the only guarantee of liquidity in a scenario of prolonged interbank friction. The second pillar involves the ownership of productive assets linked to basic biological and energy needs. Agricultural land, water rights, and distributed energy infrastructure represent the ultimate expression of tangibility. While the value of a bond can be erased by government decree or 20% inflation, the demand for food and energy is non-negotiable. In a world where global trade has been militarized, the ability to produce value locally becomes a personal sovereignty asset. Large institutional capital has already begun this move, abandoning overvalued tech stocks to acquire finite natural resources. This is defensive realism, positioning oneself at the base of the pyramid of needs to ensure that wealth maintains its real purchasing power, regardless of what happens on Wall Street's screens. A critical aspect of the exit strategy is the reduction of counterparty risk. In the traditional financial model, every investment is a chain of promises. The bank promises to custody the money, the broker promises to execute the order, and the state promises to back the system. In the debt trap of 2026, every link in that chain is a potential point of failure. Resilience requires simplifying these structures. This involves increasing direct ownership and reducing reliance on digital intermediaries that can be nationalized or blocked during a debt crisis. Strategic intelligence today means understanding that in times of systemic fracture, what you cannot touch or control physically, you do not truly own. Nominal wealth evaporates in crises. Only operational wealth remains. Finally, we must understand that the debt trap is also a psychological trap. The system relies on the population keeping their capital within established circuits out of fear of volatility or historical inertia. Breaking that inertia is the most difficult and necessary step. The new economic order emerging in 2026 will not reward speculative boldness, but strategic prudence. The volatility we see in today's markets is merely the noise of a dying system. Behind that noise, there is a massive transfer of wealth from those who trust in printed promises to those who hold the reality of strategic resources. The conclusion is undeniable. The state is no longer the protector of value, but its primary threat. Strategic intelligence is no longer a luxury. It is a prerequisite for survival in the coming era of tangible assets. If you find this level of deep dive analysis essential for your decision-making process, subscribe to Economy and World. Our mission is to provide the operational clarity required to navigate the structural disintegration of the old financial order. Join a community of global citizens who prioritize resilience over speculation. Knowledge is the only asset the state cannot devalue. The structural disintegration of the global debt architecture in 2026 is not an isolated financial event, but the violent birth of a new monetary era. We must accept that the period of abstract wealth, where value was derived from the infinite expansion of credit and the stability of central bank promises, has reached its mathematical and social expiration. The sovereign debt trap is the final stage of a 50-year cycle that began with the end of the gold standard and is now concluding with the unavoidable bankruptcy of the state's fiscal credibility. Those who continue to wait for a pivot back to the normalcy of the past decade are essentially waiting for a ghost that no longer exists in the machinery of the modern world. The crisis is not coming. It is already being managed through the digital enclosure of CBDCs and the militarization of resource supply lines. The Great Reset of 2026 is, in its essence, a return to the fundamentals of power. In a world of unpayable debt, power flows toward those who control the physical reality. The era of the paper promise is over. The era of the tangible asset has begun. And the window for this strategic transition is closing as rapidly as the debt clock is accelerating.